Welcome to the deep dive. We often think that the big investment enemies are things like market crashes, maybe picking a bad stock. But what if the biggest hurdle isn't really the market at all? What if actually it's us, the person making the calls? Today, we're taking a deep dive into exactly that. How our own feelings, fear, greed, impatience can end up costing us way more than any bad market day. It really can be true that beating yourself is harder than beating the market. And to help us unpack this really fascinating human side of investing, we've pulled some key ideas from two absolute giants in the field. Our sources for this deep dive are some classic excerpts from John C. Bogle's Common Sense on Mutual Funds and, of course, Benjamin Graham's The Intelligent Investor. These aren't just dusty old books, right? They offer some really timeless wisdom on these psychological traps that, frankly, can trip up just about anyone, even the smartest folks.
Absolutely. And that's really our mission today. We want to pull out the most important nuggets of wisdom from these texts. The goal here is to help you, our listener, really grasp the critical role your own psychology plays in whether you succeed or fail as an investor. And maybe more importantly, how you can sidestep some of those really common self-defeating habits that just wreck so many portfolios.
Okay, so let's just dive right in. Bogle puts it so incredibly plainly. He says, impulse is your enemy. Eliminate emotion from your investment program. That's pretty direct, isn't it?
It is. It really cuts to the heart of it. It suggests the main battle isn't out there in the market noise. It's right here inside our own heads. And Benjamin Graham, the Intelligent Investor, he gives us this fantastic analogy for understanding this whole dynamic. He describes the market like a pendulum, always swinging back and forth between totally unsustainable optimism on one side and completely unjustified pessimism on the other.
A pendulum. Okay.
Yeah, think about it. When everyone's euphoric, stocks get way too expensive. It just bid up like crazy. But then the mood swings, pessimism takes hold. Maybe it's justified, maybe not. And suddenly, perfectly good stocks are selling for pennies on the dollar. Graham says the intelligent investor is basically a realist in this whole emotional circus. They sell to the optimists when prices are silly high, and they buy from the pessimists when things look bleak and cheap. It just shows so clearly how much market movement is driven by, collective human emotion, not always pure logic.
Right. So if the market is this emotional pendulum, like Graham says, how does that actually, manifest? What do investors do because of these feelings?
Well, Bogle points to what he calls consistently counterproductive investment patterns, and he's got the numbers to prove it. It's quite stark, actually. He notes that back in the 60s and 70s, the annual turnover rate in mutual funds, how often they bought and sold stocks, was only about 8%.
8%. So they held stocks for what, like 12, 13 years on average?
Yes, exactly. A long-term perspective. But now, or at least when he was writing, that turnover rate had jumped to 31% annually.
31%. So the average holding period is down to like 3 years?
Just about 3 years. It's a massive, massive shift. And it really suggests investors are much more active, much jumpier, potentially much more driven by short-term emotion.
Wow.
And it connects perfectly to what Graham called trading as if your underpants are on fire. It's this frantic short-term focus. And Bogle stresses this isn't just, individual investors panicking. Even professional fund managers got caught up in it. He noted that back in 1997, the average portfolio turnover for general equity funds was a staggering 85%.
85. So holding stocks for barely more than a year.
Yeah, just over a year on average. Compare that to the 1940s through the mid-60s when it was more like 17%. Much more patient. And all this chopping and changing, this high turnover, whether it's you doing it or your fund manager, it just burdens your portfolio with enormous costs. You've got transaction fees, taxes. It all eats away at your returns.
And this kind of rapid-fire trading, it isn't just about turnover itself, is it? It often stems from something deeper, right? Like chasing whatever's hot. So many people see a fund that's gone up fast and they just pile in, assuming, hey, it did well last year, it'll do well next year.
Exactly. Graham totally nailed this. He called it a human inborn tendency to believe that the long run can be predicted from even a short series of outcomes.
Yeah. We just want to believe that hot streak will continue forever.
You really do. But Bogle brings in this crucial concept to, pour some cold water on that idea. Reversion to the mean, RTM. And he's incredibly blunt about it. He says there is no evidence, none, that superior past performance is predictive of future success. Full stop.
None at all. That feels counterintuitive.
It does. But the evidence is strong. And he gives this amazing, really vivid example. The Legg Mason Value Trust Fund. This fund did something incredible. It beat the S&P 500 for 15 years straight. 15 years, from 1991 to 2005.
Wow, that's impressive. You'd think they cracked the code.
You would. But then, right after that amazing run from 2006 to 2008, it lagged the S&P 500 by a jaw-dropping 43 percentage points.
43 points behind. Ouch.
Exactly. It's just such a stark lesson in reversion to the mean. What goes way up often comes back down, sometimes hard. Past glory is no guarantee.
And it's not just extreme examples like that, right? I mean, think about the Morningstar star ratings. So many investors use those.
They do, and Bogle points out something fascinating. Even Morningstar itself, pretty candidly, admits their star ratings have little predictive value.
Really? Even they say that.
Yep, and studies back it up. They've shown that if you systematically buy funds right after they get 5 stars and then sell them when they lose that top rating, well, you actually end up with below-market returns and above-market risk.
So chasing the stars actually hurts you.
It does. It's that classic behavioral trap. Hope, maybe fear of missing out, drives you to do the exact opposite of what's rational. And Graham, he was always skeptical of complexity used to justify maybe shaky decisions. He warned against fancy math models for speculation. He basically said, the more elaborate and abstruse the mathematics, the more uncertain and speculative are the conclusions we draw therefrom.
Meaning, if it looks too complicated.
It's probably hiding a gamble, not revealing a sure thing. Emotion can easily wear a disguise of, complex analysis.
Okay, so we've got impulse, chasing performance, leading to high turnover, jumping into hot funds that then cool off. What's the actual, dollar and cents damage here?
The costs. Bogle hammers this home. Cost matters immensely. He talks about the tyranny of compounding costs. Even tiny differences in the fees you pay each year, they don't just subtract, they compound. Over decades, the difference in your final wealth can be absolutely staggering. It's like a silent thief in your portfolio.
Okay, let's break that down. What kinds of costs are we talking about?
Right. So first, the obvious one, expense ratios. Bogle lays it out. Low-cost index funds might charge, say, 0.2% year. Average active funds, more like 1.5%. And some high-cost funds can be 2.2% or even more.
That difference between 22% and 2.2%, it sounds small year to year.
It sounds small, but think about Bogle's example. A simple 65% stock, 35% bond portfolio. Let's say stocks return 10% and bonds 6.5% before costs. With the low-cost 0.2% fund, your net return is 8.6%. With the high-cost 2.2% fund, it drops to 7.3%. That's a 1.3 percentage point difference every single year.
And over 20, 30, 40 years, it really adds up.
Massively. It's the difference between a comfortable retirement and, well, maybe not. But that's not all. Then you have the hidden transaction costs. These aren't in the expense ratio. Bogle explains that all that high turnover we talked about, funds trading 80% of their portfolio annually, generates brokerage commissions, bid-ask spreads, hidden friction. He estimates this adds another 0.5% to 1.0% or even more on top of the expense ratio.
Wow, so that 1.5% average expense ratio could easily be 2.0% or 2.5% in total drag.
Easily. Graham actually did a calculation suggesting that typical active fund needed to beat the market by about 3.5 percentage points before costs.
Yeah.
Just to match the market after all costs were factored in. That's a huge hurdle to overcome year after year.
And there's one more big one, right?
Yes. The often ignored one, taxes. Bogle calls taxes the black sheep of the mutual fund industry. Managers often focus on pre-tax returns, but you, the investor, only get to keep the after-tax amount. Actively managed funds, because they trade so much, tend to generate a lot of short-term and long-term capital gains. These get distributed to you, and you owe taxes on them usually every year, even if you reinvest them. They're very tax inefficient.
Whereas index funds holding steady.
Much more tax efficient. They trade very little, so they realize fewer gains.
Yeah.
Bogle showed the original Vanguard S&P 500 index fund beat 94% of active funds before taxes over 15 years. But after taxes, it beat 97% of them. He estimated active funds were basically forcing investors to needlessly sacrifice 30% of the stock market's gain to the tax collector.
30% just lost to taxes due to active trading, driven by those emotional decisions we started with. It all connects.
It's a vicious cycle. Emotion leads to high turnover, which leads to high costs and high taxes, which decimates your long-term compounded return.
Okay, so we've dissected the problem pretty thoroughly. The emotional pitfalls, the costs. If we're trying to fight our own worst impulses, what's the actual game plan? What do Bogle and Graham tell us to do?
Well, the beautiful thing is their guidance is incredibly consistent and refreshingly simple, almost deceptively simple in today's complex world. Bogle lays out these almost mantra-like rules. Invest you must. He says the biggest risk isn't short-term bumps, it's the long-term risk of not being invested, of missing out on growth. Then, time is your friend. Give yourself all the time you can. Compound interest is a miracle. And finally, back to the core. Impulse is your enemy. Eliminate emotion. It's all about patience, discipline, and letting time and compounding do the heavy lifting.
And that emphasis on simplicity really comes through, doesn't it? Bogle argues that chasing complex, high-performance strategies is just a distraction.
A costly distraction.
Yeah.
He says the relentless pursuit of unrealistic performance distracts them from one of the most important secrets of investment success: simplicity. We're always sold the next complex thing, but the real power is often in keeping it simple.
And Graham echoes that, right. His advice seems very grounded, very focused on not messing up.
Completely. Graham's core advice is pure discipline. If you own good stocks, expect prices to bounce around. Don't get scared by drops. Don't get giddy about surges. Remember, he said, market quotes are just there for your convenience. You can use them if they offer a good price, or you can just ignore them. Crucially, you should never buy a stock because it has gone up or sell one because it has gone down.
Such simple rules, but so hard to follow sometimes.
So hard. He even gave a practical tip. Never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. Just let the dust settle. For Graham, it was all about investing based on protection. Protection from paying too much. Protection from your own overconfidence, not based on trying to project or predict an unknowable future.
So, boiling it all down, after analyzing the emotional traps and the costs, what's the practical vehicle they both seem to point towards for most of us?
Yeah, they both land in a very similar place. The ideal choice, as Graham hinted and Bogle championed, for the vast majority of investors is simply a low-cost, broad market index fund, like a total stock market index fund.
Just own the whole market, keep costs minimal, and stay disciplined. Precisely. Bogle presented compelling data. An all-market index fund operated at a total cost of 0.2%. Would have provided an annual return of 18.7% or nearly 99% of the total market return during a specific period he studied. He also showed that over time, that index fund captured about 97% of the market's total growth for the investor. The average managed fund only delivered about 70% because of those costs and inefficiencies. The gap is huge.
So, bringing this whole deep dive together then, the message seems overwhelmingly clear. Your own behavior, your own reactions fueled by emotion often play a bigger role in your investment outcome than anything the market throws at you.
That's the crux of it. Mastering yourself really is the harder part. And the timeless wisdom from Bogle and Graham provides the blueprint, a disciplined, long-term, incredibly low-cost approach. It's designed specifically to minimize the damage our own impulses can cause. It's about setting up a structure where that miracle of compounding works for you, day in, day out, instead of letting your emotions work against you.
Which really leaves us with a final, maybe challenging thought for everyone listening. Given how clearly these two investing legends show that our emotions and our tendency to think short-term constantly erode our wealth, what concrete, maybe even daily practices can you put in place to make sure your financial decisions are driven by a cool-headed reason, not by gut reaction? How can you truly, genuinely master yourself when faced with the inevitable ups and downs of the market?